Great to have you with us here on
Thanks.
In the Loop. And what do you make of these daily huge fluctuations in the markets?
Yeah, that's what scares investors the most, is that not the intraday volatility, it's the intraday volatility. So we're up 300 yesterday, maybe we're down 300 today, who knows where this goes. People are tired of that. The confidence and the trust factor in the markets are getting it's starting to wear on them. And, if I'm a stock picker and I'm picking, say, a small cap, material stock or whatever, that stock runs with everything else. That's why everyone talks about the correlations being so high. Right now, we're all correlated to the euro or the Aussie yen or the New Zealand dollar. Pick one. Why are equities running with them? Well, because it's a different world. The markets, as we know it, are broken. Okay, the equity market broke a while ago. It's now one big correlated giant ETF that trades together. So you need to kind of separate the value. And the problem is, investors like you were just talking about, do they have that long-term horizon where they could wait 5 years? They know they've picked the right stock, but they get caught up in the ups and downs of it. So it's very difficult for managers to compete, which is why you've seen over $130 billion come out of domestic equity funds year over year. Now, some of it's gone into ETFs, about $60 billion of that. People check, ETFs are easier to buy and sell because, hey, I don't have to actually pick the stock. I just go with the ETF. But that's not real investing.
Well, do customers, though, need to be re-educated? I mean, this could be a golden opportunity for finding very beat-up investments that shouldn't be so beat up. So maybe fund managers need to get out and maybe do a little more aggressive marketing of the longer-term horizon.
Yeah, I agree with that. And there also could be some really good shorts out there as well. I look at things from the other side. I'm kind of a contrarian. I could see a stock that's way overvalued and say, I'll short that here. In the meantime, there could be a short squeeze going on, similar to like you saw maybe in Jeffries or something else yesterday. That'll hurt you on the other side.
Well, now, all of this correlation, this relationship trading that you're talking about is because of technology. Let's be frank, all right?
Yes.
We have computer models, hedge funds that can just program it to, if this happens,
That's
do
right.
this. So can we expect this to continue going forward, or is this just going to be something that's a flash in the pan?
There's no doubt it will continue. In fact, it'll probably get worse. I'll give you a quick fact. Only 12% of the volume that you see out there is institutional-based volume. The rest of it, some of it is retail, some of it is day trading, but a good chunk of it is arbitrage strategies, ETF arbitrage, rebate arbitrage, latency arbitrage.
These
all
computers that go back
just
and forth.
jerking back and forth all day long, trying to scalp a penny here and there. And hey, look, I get it. I get their game. I understand what they're supposed to do, and they're making money for their investors and so on. But it's hurting everybody else. Okay, here is the price valuation correct when 80% of it is being moved around by computers who don't know who the CEO is, who don't care what the last quarter earnings are. All they care about is, okay, which way is the euro going? Did it break the 200 million moving day average? Let me go follow that along. It doesn't make any sense. But if, like you said, if you have that long-term horizon, yeah, in the end, hopefully you'll be right.